Welcome back, everyone. Today, we are going to be taking on a really interesting topic, the relationship between interest rates and the stock market. And like, if you've ever kind of wondered why the stock market like freaks out every time like the Fed raises interest rates, this is going to be the episode for you. So, let's get right into it. Interest rates, what they are, why they matter. First off, interest is the cost of borrowing money. It's what you pay to essentially rent money from somebody else. Could be a bank, could be a person, right? Like you could lend money to a friend and charge them interest. It's just the cost of using someone else's money for a period of time. And this applies to all sorts of borrowing. Like if you take out a personal loan, if you use a line of credit, mortgages, companies, when they issued debt, all of that is governed by interest rates. And it's important to note that interest rates are not all the same, right? They can vary depending on a bunch of different factors. One is the length of the loan. So like generally speaking, longer term loans will have higher interest rates than shorter term loans. And then another thing is the credit worthiness of the borrower. So if you have really good credit, you're probably going to get offered a lower interest rate because you're seen as a lower risk to the lender, right? If you have bad credit, you're probably going to get charged a higher interest rate. And then there's other stuff too, like, what currency the loan is in. But we won't get into that too much today. Now, underlying all of this is this concept called the time value of money. And that basically just means that a dollar today is worth more than a dollar tomorrow. Like, think about it. If I offered you a dollar today or a dollar a year from now, you'd obviously take the dollar today, right? Because you could invest that dollar, you could buy something with it and potentially earn a return or, have something now. So that's why lenders need to be compensated for lending out the money because they're giving up the use of that money today. They're giving up the opportunity to do something else with it. Now, in the US, the big player when it comes to interest rates is the Federal Reserve or the Fed. And within the Fed, there's this group called the Federal Open Market Committee, the FLMC. And they're the ones who set the federal funds rate. Now, what is the federal funds rate? It's basically the target rate that banks use to lend and borrow money from each other overnight. So banks have to hold a certain amount of reserves, right? And if they're short on reserves, they can borrow from other banks. And the federal funds rate is like the benchmark for that lending. It's the rate that the Fed is aiming for. The Federal Reserve Bank of New York actually tracks this rate daily to see how it's doing. So how does the Fed actually go about influencing interest rates? Well, they have a couple of main tools. The first one is directly adjusting the federal funds rate targets. If they want to raise interest rates, they'll increase that target. And if they want to lower interest rates, they'll decrease it. Now, this affects banks directly because it makes it more or less expensive for them to borrow from each other. But those changes kind of trickle down throughout the financial system and eventually impact the rates that consumers and businesses see on things like mortgages, loans, credit cards, all that stuff. The second tool that the Fed has is open market operations. And this basically just means buying and selling government bonds in the open market. So if the Fed wants to increase interest rates, they can sell bonds. And what that does is it takes money out of the economy. It reduces the money supply, and that makes money more scarce. And that tends to push interest rates up. They'll often do this if they're trying to slow down the economy or get inflation under control. Because when interest rates are higher, people and businesses are less likely to borrow money and spend it. And then on the flip side, if the Fed wants to lower interest rates, they can buy bonds, and that injects money into the economy. It increases the money supply, and that makes money more plentiful, which tends to push interest rates down. They do this to try and stimulate the economy or prevent a recession because lower interest rates make it cheaper to borrow money, and that can encourage spending and investment. Now, it's important to remember that while the Fed raising the federal funds rate directly increases the cost of short-term borrowing, the impact on longer-term interest rates is not always as straightforward or immediate. Those are affected by a bunch of other things like expectations for future economic growth and, really importantly, inflation. Speaking of inflation, let's talk about how that plays into interest rate decisions. So generally speaking, interest rates tend to move in the same direction as inflation. If the economy is booming and prices are rising radically, the Fed might decide to raise interest rates to try to cool things down. Higher rates make it more expensive to borrow money, which can lead to a decrease in consumer spending and business investment, which then helps to slow down the economy and hopefully bring inflation back under control. And often you'll see inflation start to fall after interest rates have been increased. Now, if the economy is sluggish and inflation is low, the Fed might lower interest rates to try to stimulate economic activity. Cheaper borrowing costs can incentivize businesses to invest more and consumers to spend more, and that increased demand and can lead to a rise in inflation. And so sometimes you might see inflation pick up after a period of lower interest rates. Now let's shift gears and talk about how these changes in interest rates actually affect the financial markets. We'll start with bond prices because the relationship here is pretty straightforward. There's an inverse relationship between interest rates and bond prices. So basically, when interest rates go up, bond prices tend to go down. And when interest rates go down, bond prices tend to go up. It's like a seesaw. When one side does up, the other side has to go down. Why does this happen? Well, imagine you have a bond that pays a fixed rate of interest, let's say 5%. And then suddenly market interest rates go up and new bonds are being issued that pay 6%. Well, your bond with its 5% interest rate is now suddenly less attractive, right? Why would anyone buy your bond when they could get a new one that pays 6%? So to sell your bond, you'd have to lower the price to make it more competitive with the new bonds. And that's why when interest rates in the market are rising, the prices of existing bonds tend to fall. And the same thing happens in reverse. If market interest rates fall, your bond with its higher interest rate becomes more valuable. People are willing to pay more for it because it's offering a better return than the new bonds that are available. So when interest rates decrease, the prices of existing bonds generally tend to rise. This is especially true for longer duration bonds. Those are bonds that mature further out in the future, and they're more sensitive to interest rate changes because even small changes in rates can have a big impact on their value. Now let's talk about the impact of rising interest rates on stock prices. This relationship is a bit more complex and there are a lot of factors that come into play, but generally speaking, higher interest rates tend to have a negative impact on stock prices. One reason for this is that when interest rates rise, it becomes more expensive for companies to borrow money. That makes it less attractive for them to invest in new projects or expand their operations because the cost of capital is higher. And for projects that are already financed with debt, higher rates mean higher interest expenses, which can eat into profits. Another thing to consider is that higher interest rates can lead to reduced profit margins. If a company has a lot of debt, higher borrowing rates will increase the amount they have to pay in interest, which leaves less money left over for profit. And that can make the company less attractive to investors and potentially lead to a lower stock price. Higher interest rates can also lead to decreased consumer demand. When borrowing becomes more expensive for consumers, they might be less likely to make big purchases like cars or houses, and that can hurt the sales and profits of businesses, which can then be reflected in lower stock valuation. But maybe the most important impact is that when risk-free interest rates go up, like the rates on US Treasury bills, riskier assets like stocks become less attractive to investors. Think about it. You can always choose to put your money into those low-risk investments like Treasury bills. They're backed by the US government, so they're considered to be very safe. When the returns on those risk-free assets go up, the potential returns from holding riskier assets like stocks need to be even higher to justify taking on that extra risk. And that brings us to the concept of the risk premium. The risk premium is basically the extra return that investors expect to earn for holding a riskier asset like a stock compared to a risk-free asset like a US Treasury bill. As interest rates rise, the returns on those risk-free assets increase, and so the required risk premium for investing in stocks often goes up as well. Investors will demand a higher potential return from stocks to make up for the greater risk they're taking, and that can lead to lower stock valuations or prices. Now, on the flip side, when interest rates fall, risk assets like stocks can become more attractive because that required risk premium decreases. With lower returns available from low-risk assets, investors might be more inclined to put their money into stocks in search of higher returns, and that can drive stock prices up. So to sum all this up, falling interest rates generally stimulate the economy by making borrowing cheaper, encouraging both investment and spending, and potentially leading to higher economic growth. In the stock market, lower rates can make stocks look more appealing compared to bonds, and can reduce borrowing costs for companies, which can be good for stock prices. And if most in bonds that were issued with higher interest rates become more valuable, rising interest rates, on the other hand, generally aim to slow down the economy and get inflation under control. They made borrowing more expensive, which can lead to less investment and spending. In the stock market, higher rates can make stocks look less attractive compared to bonds, can increase borrowing costs for companies, and can potentially lead to lower stock prices. And as existing bonds that were issued with lower interest rates become less valuable. It's important to remember that the actual impact of changes in interest rates on the stock market is complex and depends on a lot of different factors. You've got to think about things like expectations for economic growth, corporate earnings, global events, all that stuff. And plus the effects of interest rate changes on the overall economy often take a while to fully play out. So understanding the connection between interest rates and the stock market can give you a lot of valuable insight into how the financial world works. And if you found this informative and helpful, please hit that like button and subscribe to the channel for more deep dives into the world of finance finance and economics. All right, that's all for today. Thanks for listening.